Did you know that you can use real estate asset, whether it's your own home or your investment property, to make more money? And that money is tax free, and you can use that money to further invest in real estate asset to increase the properties in your portfolio. So this money printing hack is being used by most of the investors who have got multiple property in their portfolio. And finally, the most important tactical point, it is not what you want to hear, but you need to hear to move towards the financial independence. If you are interested in knowing that hack, stay tuned. Hi guys, this is John from Admire Property Group. I'm running an independent buyers agency where we help people in acquiring high performing real estate asset, which grow in value with time and gives you good rental income and cash flow, basically making it self-sustainable investment, which doesn't put a lot of pressure on your finances and navigates you to the financial independence eventually. Welcome back to another episode on this channel where we talk about real estate, financial literacy, financial independence, and passive income. And if you are new to this channel, make sure you like and subscribe to the channel so that we can get the motivation to produce more of these kind of videos. In today's video, we'll discuss like what is equity and how bank calculates the equity and what tactics bank can use to have more power on your portfolio, which you should avoid, and how can you use equity to increase your portfolio. And finally, the most important point, what points you should consider to boost your equity faster. So let's start with an example. Assuming that you bought a house a couple of years back, you bought it at a price of $600,000 and you used LVR as 80% and you paid 20% as a deposit from your pocket, from your savings. So the 80% of $600,000 is $480,000. So $480,000 is a loan which you took from the lender to buy that property. So you bought that property at $600,000 with a loan value of $480,000. And assuming that you are paying only the interest, not the principal plus interest, and it's been a couple of years now or few years now, and the value of the properties in your area have increased. So a property similar to your property is valued at as like $950,000. It could be you have met some sales agent, he has given you some sales appraisal, and he's giving the value for your property as $950,000. So I will ask you a question now regarding the equity, and would like you to answer that question in the comments below before watching this video further. My question to you is, the agent and the value of the property as per your assumption is $950,000, and loan on the property which you bought a couple of years back is $480,000. So what would be the equity as per your calculation? Make sure you write the answer below without watching this video further, because I just want to see like how many of you get the right answer, because most of the times people calculate their equity incorrectly. And most of the times people will say the equity is $950,000 minus $480,000, which is $570,000. So if you are saying that your equity is $570,000, you are totally wrong. Because what happens most of the times when we go to the bank for the valuation, they have got their own team which will give the valuation for your property. And when they do the valuation for your property, they want to keep themselves safe. So to be on safer side, they will give you a valuation of your property like 5%, 10%, or 15% lesser as compared to the actual value in the market. So for your property, which you think will be valued at $950,000, most of the times bank will come at like value of $900,000. So let's say banks comes up with a valuation of $900,000 for your property. And now the bank will not lend you 100% of that value. They will consider the LVR percentage. For example, if they take 80% LVR, they will consider it as 80% of $900,000, which will come out to be $720,000. So $720,000 will be a new loan for you. And the old loan, which was $480,000, the difference between these two is your real available equity. So because we are using bank's debt, taking debt from the bank, so we'll have to go through the bank's policies and rules and regulations. This is how they calculate the available equity for you. And always remember, yes, banks' focus is to make money, but their main focus is to protect themselves against your asset as well. So that's why they never give you the 100% of the value of your property. They always give you with certain LVR ratio, whether it's 80% or 90%. They will keep 10% or 20% as a safe deposit for them to protect themselves against any unforeseen event. And the next important thing which you should keep in your mind is like bank will always check your borrowing capacity, because there could be some unfortunate events that you are not working anymore, or you are changing your job, or your financial situation has changed. So whenever you go to the bank to access that equity, they will check your borrowing capacity, and they want to make sure that you are capable to service the debt which you are asking for them. So you are capable enough to service the debt based on your borrowing capacity. So until unless you have the borrowing capacity, this equity which looks accessible is not accessible, is totally locked and useless for you. And if you have got the equity accessible so that you can use it in your further investment, there are other rules and constraints which you should follow for your next investment. Now, let's say you want to invest your equity on your next investment property, and you want to buy a property of $500,000, and taking the LVR as 80%, you will have to pay $100,000 as a deposit. I'm just keeping the LVR as 80% because it makes the number easier, and you can go up to 90% LVR, but in that case you will have to pay LMI, which is lender's mortgage insurance. If you want me to make another video on LMI, just comment in the section below and I will make another video on LMI for you. So let's go back to the example. You want to buy an investment property of $500,000, and with 80% LVR you will have to pay $100,000 as deposit, and some other costs like stamp duty and other costs you around $20,000. So total you will have to pay $120,000. So rather than using the full equity of $240,000 towards the deposit of your investment, you should use $120,000 to buy that investment property, which is like $500,000. And when you are buying a property of $500,000, make sure you do your calculation properly when you are calculating the rental returns from that property, because most of the time people think that $400,000 is a loan for the investment property, but if you consider the $120,000 which you took out of the equity, the total loan is $520,000 in this example. So you will have to base your rental income calculations on $520,000 loan, not on $400,000 loan, because in this example you are borrowing $400,000 plus $120,000 from the equities. So your total borrowing is $520,000, and make sure you base your calculation of interest charges on a loan of $520,000. Now you have got one investment property of $500,000 and you want to increase your portfolio further. Now there are two options for you. The first option is you wait for that investment property to grow in value and take equity out of that property and use it for your next property, which will be after 2 years or 3 years. Or the second option is you can use the leftover equity of $120,000 from your own home and use it to buy another property of similar value in different area. Why I'm saying in different area? So as to keep different eggs in different baskets. So whether you want to wait for your first investment property to rise in value, or you want to invest current equity in another property, it depends upon your risk profile or your risk appetite. It depends upon you that how aggressive you are in investing into the properties. So assuming that you have bought another property as well, so you got two investment properties and one home now. They are all increasing in the value, and in couple of years, like 1 or 2 years, the value of all the 3 properties will increase, and you can take equity out again from 3 properties, or you can leave your home as it is and take equity out of those 2 properties and use that equity to buy further properties in your portfolio. You can keep on increasing the number of properties in your portfolio, but caveat to that is you should have your borrowing capacity when you are investing into the further properties. And now you have multiple investment in your portfolio which are growing by value. So you can consider them as a separate money printing machines for you, as these are growing in value. So you can take equity out of these properties for your next investment faster. And the most important point to note about the equity is the equity which you use is totally tax-free. It's tax-free, but not the interest-free. So you should be very careful when you are doing your calculation for the cash flow. Make sure you invest your money in a good area with strong data factors, which will give you a good cash flow, because you will have to pay a lot of interest because you are taking the loan and increasing your loan or debt every year by investing it in further properties. And if you need any help in finding out a good location for your next investment where all the data factors are stacking up, you can contact us anytime. Our contact details are given below. This is how a lot of investors are using their equity to buy further properties and increasing their property portfolio. And if your portfolio is positive cash flow, the extra cash which you get from your portfolio, you can use it to pay off the debt from your own home. Or after 5 years or 10 years, when you have got multiple assets in your portfolio, you can sell one or two or three of the properties at very good price and use that profit to pay off the debt for your own home. And finally, the most important tactical points to boost your equity, which I promised in the start of the video, make sure when you're investing, invest in an area which has got a good capital growth, because with the capital growth, the value of your property will increase faster and you would be able to access your equity faster. And second one is you're buying at a very good price, because when you're buying a property and you're buying it at lesser price as compared to the market, you have already got an equity in your property. And the next is valuation. When you go to the bank, they use different valuers, and these different valuers use different factors to calculate the valuation of your property. So you can come up with 3 different valuations for the same property. So make sure you're going to a bank which is giving more valuation for your property. So that gives you more equity. And the next one is you can increase your LVR ratio. So rather than going for 80% LVR ratio, go for 90% LVR ratio. So in this way, you would be able to access more of your equity, which you can invest in further investments. And make sure when you are using equity, the banks are not cross securing your loans. Cross securitization of the loan means like they connect both the loans together. So when something happens wrong, the bank has got more power on your assets. So they can decide which asset to sell so as to cover up their money. So make sure you are not cross securing your loan and keeping those loans as a separate loan if you are dealing with the same bank. So I hope you enjoyed the video, guys. And if you want to boost it further, boost your portfolio further, make sure you watch my another video, like how to increase your borrowing power. So increasing your borrowing power will help you in boosting your portfolio and making yourself financially free eventually. So bye for now and see you in my next video. Thank you.